in this environment. And Peter had some, we were talking about gold potentially basing here.
Well, I think it's been building this base now for a couple of years, and you'll notice, every time we get down below 1,200, people start saying, this is it, it's going to collapse, gold's going below 1,000, and it never does. I mean, there's some real buying that takes place. There's a lot of, major players, central banks, that really want more gold. They want to buy gold without driving the price up. So whenever it comes down, these buyers come out. And I think people who are holding off for some final capitulation where gold goes sub 1,000, I think they're going to be waiting too long and end up not buying gold at all. Or, maybe they do buy it at 1,500 or 1,600, or, the worst case would be they don't buy it at all. It just runs away from them. And they end up with nothing, even though their intention was to buy, but they got too greedy because they thought they would be able to buy it cheaper.
Yeah, I do think that there is the possibility that it could go below 1,000, though. However, I don't think you're going to be able to buy physical gold for below 1,000. The last time that there was a, in the crisis of 2008, when gold plunged down to the high 700s, I believe it was, and back then there was a divergence that happened between physical gold and spot gold on the futures exchange, the commodities exchange. So the price of paper gold might go down there, but I don't think the physical gold will. And so what I've been doing is I buy every month myself. I've been accumulating gold for years now, and so I'm, I was an investor in precious metals before I became a precious metals dealer.
Yeah.
And I looked at this thing as a long wave cycle, and I wanted to be into it until the end. And you can measure the end with things like the Dow gold ratio and the gold real estate ratio, and we're nowhere near the end yet.
And you mentioned the paper market, which is larger than the physical market.
Right.
But when there's panic selling in the paper market, there's not necessarily in the physical market.
Correct.
Because there's no real delivery going on. But the real thing that's going to impact the metals market is when there's panic buying in the paper market. Because you're going to have a situation where a lot of people think they have bought a gold in the future. They think they have the ability to take delivery on gold. And there could come a point in time where a lot of the people who have futures contracts that own them actually look to take delivery. And now the shorts, those who have sold those contracts, are now obligated to supply physical metal, which they don't have and which might not even exist. And so you could see a huge...
Well, it doesn't exist. It's always greater. The amount of the eligible gold on the COMEX is always much smaller than the number of contracts that are...
So I think the big market-moving event in the paper world is not a plunging gold price, but a skyrocketing gold price. And that's what people have to brace themselves for. And that can happen any day. I mean, you don't know. I mean, because we already know that there's so many contracts that have been sold into the market by people who have no ability to deliver because they don't believe they're ever going to have to. But, Murphy's Law, right? Anything that can go wrong eventually will go wrong. And that is an accident waiting to happen. But, you want to own gold, real gold, when that does. I mean, because there are some people that think they own gold because they own a futures contract or they own an option on a futures contract. But that's only good as the ability of the other side of that trade to deliver on a commitment that it has no possible way of doing.
Right.
Yeah.
Yeah, and I look out, like, by the year 2020, I think gold is going to be many, many, many times its current price. And so whether it pulls back another 100 or 200 or 300 from where it is right now, I don't really care. Yeah. I just keep on accumulating because I know, it's gone up, it's taken this little dip, but it's going to take off like a rocket one day. And the world is learning that all the currency systems are just Ponzi schemes.
Well, look how quickly gold went from 260, 270 up to 1,000, 1,200, 1,900. So we're at 1,200 now. So to just make that kind of move that it made earlier in the last decade, when people say, oh, gold will never be 5,000. I remember when people said gold will never be 1,000.
Right.
They thought I was crazy for saying that gold could go to 1,000 because it had never been there before. It only got as high as 800, 850 in 1980, and here gold was below 300, and I'm predicting it to go above 1,000. People said impossible, never happened. Now we're above 1,000. right? And people, oh, it can never go to 5,000. Why not? What's going to stop it? You know, and of course, as you mentioned, there's a lot more money that's in existence, a lot more paper money, rather,
right.
that's been printed.
Most objects in society, most everything that you can buy is roughly 10 times its 1980 price right now. Mm-hmm. And here we've got gold that's just a little bit over its 1980 price, and silver has yet to break its 1980 high. Mm-hmm. I can't think of anything in all of society except for maybe computer chips that where its price today is lower than its price in 1980.
Right.
Silver's like the only thing.
And it's not going to, look, either the price of everything else has to come down or the price of gold has to go up. And obviously the path of least resistance is the price of gold going up, because governments won't let the price of everything come down, because that's the deflation boogeyman that they don't want to rear its ugly head, because the government owes all this debt. And if that debt becomes more expensive to service, they'd have to default. And so inflation is the get-out-of-jail-free card that they think they can play. But unfortunately, you know, they put everybody else in the poorhouse.
Right.
Yeah. You know, there are a lot of people who, you know, are not on a relative basis, but there are people who have been entering the gold market over the last, you know, number of years. And unfortunately, a lot of them have been led astray by some of the more higher-profile companies that are able to afford to advertise. They advertise on talk radio. They advertise on cable news shows. Mm-hmm. The ads are all over the place. And people have responded. People have, you know, called in. And unfortunately, you know, they had the right idea. They wanted to buy gold. And there was a commercial that warned people about inflation and about what the Fed was doing and about how there's a crisis looming. And they had the right idea, protect yourself by buying gold. But then, unfortunately, these companies took advantage of the people who called in, and instead of selling them the gold that they called up to buy, unloaded some overpriced phony numismatic coins at these inflated markups. And so they ended up losing more money to these unscrupulous gold dealers than they were afraid of losing to inflation or to the government.
That bait and switch is something I warned about in my book, that if a company can afford to do the advertising, they're not selling the 1% bullion or whatever that they're advertising. They're doing a bait and switch and trying to scare, you know, they get you to call them, but then they try and scare you into buying some phony numismatic coin because they say it's non-confiscatable or some joke like that.
But even when they sell you legitimate bullion, they still mark it way up, and they convince you to pay more than it's worth because the commercials are so expensive. But in many cases, they get a talk show host to recommend the company as if they've actually done some independent research, and this is the best dealer they can find, when in fact they're being paid handsomely to misdirect their audience to a firm that's ripping them off. But the people are you know, they're not suspicious because they trust the talk show host who they listen to every day, and they say, aha, if he's recommending this particular company, then that's where I'm going to buy. And they don't shop around, and they have no idea how much they're being ripped off. You know, you're talking about companies that mark their bullion up 30, 40, 50, 100%, meaning that the price of gold has to double just to get your money back.
Yeah.
You know, why would you want to do that? I mean, no one would be that dumb when it comes to buying a stock. If you want to call up your stockbroker and you want to buy a stock that's $100 a share, and they say, okay, the commission's $100 a share, so now you're going to pay $200 a share, no one's going to buy that stock. Yet there are people paying literally $2,000 to buy an ounce of gold, knowing it's only $1,200 an ounce. I mean, that's why when people are going to call our firms and they're going to buy gold, you know, they're not going to be conned into buying some, you know, overpriced coin that they don't need. You know, we don't have these big advertising budgets that we need to overcome. We're not paying talk show hosts to endorse our company.
Right.
You know, we don't have, you know, big fancy offices with expensive, you know, salesmen that are going to push people into, you know, these overpriced coins. We have a lower overhead. And so we can afford to sell our clients legitimate gold and silver, which is all you really need. You don't need to become a coin collector, right? You just need to preserve your wealth by buying real gold or silver in bullion form, whether it's in a bar or in a coin.
Right. If you're buying numismatics, you're betting that there's going to be this exact correct buyer out there. With bullion, there's thousands of people buying and selling it. It's a worldwide market all the time, and you know what the price is. And with numismatics, somebody has to want the exact coin that you've got.
Well,
so
and that's assuming it's legitimate numismatics.
Yeah.
I mean, there's a lot of these coins that are not rare at all, and they're being offered as some kind of rare commodity, but they're not. They're just overpriced. But yes, if you have a legitimate numismatic coin that really is scarce, but its value is based on what somebody is willing to pay.
Right. Interpretation.
And in that case, a rare gold coin is no different than a rare piece of art or a baseball card or an antique car. It's a collectible market. And in many cases, when coin collectors, they want to increase their collections, when times are good. If you have a major economic upheaval where people are losing a lot of money, they might have to liquidate their coin collection too, in which case it might only be worth its melt value.
I recently charted out the price performance of numismatics from the year 2000 until today, and we've had this tremendous bull market in gold and silver, but numismatics have been in a bear market the whole time. These collector coins that all of the bait and switch operators push onto people have been going down. I had back in 2007, I believe it was, and I believe gold was still below 1,000. It was about 700, I think. Maybe it wasn't 2007, but gold was about 700 when I was talking with this customer, and he bought a few $100,000 worth of gold from me. And then he was asking me all about numismatics, and I told him what I thought, that it was basically a scam. And then he went and bought like $2.3 million worth of coins, numismatic coins, from one of those bait and switch dealers. And I know all of this because when gold was up at $1,800 an ounce, he contacted me and faxed or scanned and emailed the offer from the dealer that had sold him the coins, the current valuation. And his portfolio, in the time that gold went from 700 to 1,800, his portfolio had fallen by almost half.
Well, a lot of that was the commission that he probably paid right out the gate. But, another thing that these companies do is they have all kinds of gimmicks to con you into dealing with them. And, one of them is this price protection, right? Because, people are afraid, don't buy gold, because what if you buy it and the price goes down? Well, who cares? It's not going to crash. But they get people to think, we'll protect you. If you buy our coins, if the price goes down, we'll let you buy more at the same price. And so you have this downside protection. Or if the price goes up, we'll let you buy more at the same price. So trying to make people think that somehow there's less risk buying through them, because if you buy through a firm like mine or yours, and the gold price goes down 2 or 3%, well, it's 2 or 3% cheaper. But they're saying we'll protect you from that 2 to 3% drop, right? But to do that, they steal 20 or 30% of your money, because what they haven't told you is they've marked it up so high.
Right.
You're not protected from anything. Why would you overpay 30%? To protect yourself from a 2 or 3% decline, because then you're still paying more. So I'd rather buy gold at $1,200, and if it goes down to $1,150, okay, it's $50 cheaper than to pay $1,600 to buy $1,200 gold. And if gold goes to $1,150, they reprice my gold from $1,650 to $1,550. I'm still worse. The protection didn't protect me. Right, it just protected their profits because it enabled them to con me into buying their overpriced gold. So these gimmicks, any of these companies that are offering something, hey, I'll protect you, you can't lose. It's because you are going to lose. It's too good to be true. You're overpaying for that protection. When you buy bullion from a legitimate dealer, you don't need protection because you've got a good price. Well, another really good thing about bullion is it's one of the last assets that's still private, and and you can own it, and everybody doesn't know that you have it. Unless you want to tell them. But it's also a portable, and given the environment that we're in, right, with Big Brother is looking over your shoulder, it's good to be able to have some wealth that is both private and portable, because you never know what the future may bring, and it's always good to have some insurance. And gold provides you that. You don't get that in any other financial asset. It's unique to gold.
It's also extremely easy. When you're a real estate investor, there's certain problems that come with that. When you're trading stocks, I know several people where that's a full-time job. You got to know what you're doing, because you're going up against, when you're trading, you're really these days, the winners are always the big banks, their proprietary trading desks and stuff, because they have ultimate deep pockets and they can afford the best people. With gold, you buy it and you sit on it.
Yeah. Well,
There's nothing else to do. It's very, very simple.
Well, you could do, again, you can do the same thing with stocks if you buy the right stocks and you collect good dividends. And remember, when we're recommending that people own gold, we're not saying own gold to the exclusion of all else. I mean, gold has a place in your portfolio, but you do want to have other assets that you own that can provide you with income that gold does not. I mean, gold, it doesn't throw off any income. But there are stocks that you can own, and we still buy stocks around the world as a way to get out of the U.S. and to get out of the U.S. dollar. But buying and holding a stock is a lot different than just trying to speculate on the short-term movement in the price. Because most people that try to do that end up losing, because there's a guy who's trading who's a lot smarter than you, and it's his full-time job, and he's got more sophisticated equipment, and you're not going to beat him. Right, it's like a guy coming to Las Vegas who's a weekend poker player, sitting down at a table, thinking that he's going to beat the professionals who do nothing but play poker all day long. And they all sit there waiting for the vacation guy to come who thinks he can play because he plays with his buddies, on a Saturday night, and they take these guys to the cleaner. So the same thing happens. You think you're going to beat the professionals when you're going to trade your stocks, but if you own quality companies and let them grow and collect their dividends, you can make money. But I think certainly in the U.S. you've got an overvalued stock market in general, so it's not a good place to buy. But there are countries around the world where you can buy stocks, but you want to have your liquidity.
The currency crisis, though, is going to be global this time. I think that when we have this bond crisis / currency crisis, which is coming at us, and it'll. I don't know about you, but I definitely believe it's going to be before the end of this decade that we're going to have this major bond and currency crisis. At that point, gold's purchasing power against stocks globally should go up tremendously.
I believe it will, but this is where prudence comes in. I mean, I think that the crisis could happen in a few years, but what if it takes longer, right? Some people won't be able to hold on to their gold long enough. So you have to have some other assets in your portfolio, because what if it takes another 10 years? I don't think it's going to, but what if it does? And if you have everything in gold, you might not have any gold left 10 years from now because you had to sell it all off to pay your other expenses. Or you might not have
pretty much everything in gold and silver, and I've got some cash set aside in case there's deflation. And
well, I think gold works in deflation too. That's the beauty of it, because if everything comes down in price, gold will come down less. So you're still better off. But I think that a little gold will go a long way. You see, if we're right and gold takes off, you don't have to bet the farm on it. You could just own a little bit, because most people own none. So if we're right, you make a ton of money by having 10% of your portfolio in gold. So there's no reason to put everything in gold, because a little bit will go a long way. Meanwhile, if we're wrong, right, well, you haven't put everything in one asset. You've got other investments that can do well, even if it doesn't collapse.
I don't see any downside risk over the long term in gold, though. I mean, just none. I don't think that it's possible that we could see sub $1,000 gold forever.
No, but some clients don't have a long enough time horizon. If you put all your wealth in gold and then gold goes down by 50%, some people might not be able to stay the course. They might be wiped out. They might have to sell. You don't want to be in a position where you're going to have to sell your gold if the price goes down, or you're going to panic. Some people, if they have too much, it's like you could sit down at a poker table, and if you don't have enough chips in front of you, and you might have the winning hand, but somebody bluffs you out, and you just don't have the capital to stay in the game. Right, so if some people overcommit to the market,
well, if you're leveraged,
well,
that happens.
Well, leverage is when you're forced to sell, but some people can just take a bigger position than they can really handle. And I'm saying, if we're right, and I believe we're right, just having a small percentage of your gold is going to be huge.
I agree.
Plus, when the dollar goes down, we're going to have a currency crisis. All currencies are going to lose at different rates. I mean, there are going to be some currencies that skyrocket relative to gold, even though they might still, relative to the dollar. So let's say if you have money in New Zealand, or you have money in Switzerland or Singapore, those currencies might go down, but they can still go up 5 or 10-fold against the dollar, even as they're still falling in gold. So you still have a huge hedge against the dollar crisis by owning these other assets, but you don't want to put it all in one thing. As much as I like gold and as much as I own gold, and I recommend that my clients own gold as well, you have to be diversified, but you can be selective. You don't just diversify, just across the board. There are certain assets that you want to avoid. I would avoid U.S. bonds. I would avoid U.S. stocks. But that doesn't mean I'm going to avoid all stocks or all bonds, because there are some that you can buy in building a portfolio.
Okay. When I've studied currency crises and when gold is, I call it revaluing itself, but it's the public rushing toward gold or abandoning the currency, either way, and gold does this revaluation. It's usually the biggest winner of all. It's bigger than real estate or bigger than stocks. It's the number one gain in wealth transfer. And so when I saw this several years back, I decided to go into, I had probably, I can't remember the exact mix, but I probably had 50% gold, 60% gold, or maybe it was higher than that, and then some mining stocks. And then I did and I had energy and some cash, but very, very little cash. I actually have more cash now in my allocation. And I got rid of all of my mining stocks, luckily, because they have gone down quicker than gold went down. I did a study on the gold versus the Barron's Gold Mining Index of some of the largest cap gold stocks. And it showed that from 1970 to today, that gold had outperformed the Barron's Gold Mining Index by 400%.
Over those extended time periods. But if you go back to the crisis, you go back to the Great Depression, you go back to the bull market in the 1970s, gold stocks significantly outperformed gold. And so if we get into a situation where gold goes from, let's say, 1,200 in the next 5 years to 5,000 or 10,000, you're talking about a tripling or quadrupling in the price of gold, you'll see 10, 20, 50 times gains in stocks. So and that's why I think that if somebody really wants to get leverage to the upside without borrowing money, if they put 5 or 10% of their portfolio in mining stocks, that's like having 50 to 100% in gold bullion, because the amount of leverage, even from today, if gold,
the amount, if you're doing that at a bottom, and we may be near a bottom now, when you take like the Barron's Gold or the HUI divided by the price of gold, we could be,
and the sentiment couldn't be worse for this sector. And you can take the market caps of all the gold stocks that exist in the entire world, and it wouldn't even be a mid-sized Fortune 500 company. So all of the gold stocks, every company that exists. So these stocks are dirt cheap, and if gold's going to go up, the stock, so you can get that leverage without having to borrow money. So I do recommend people have some physical bullion.
I used to have 53 different mining companies, and one of them I had a 40-bagger on. Back from 2003 to I think 2000, can't remember, 2006 or 7 when gold went up to $1,100. That period of time, one stock that I had went up 40-fold. It was huge.
And look, that's going to happen again. There might be some that go up 100 times, but of course there'll be some that go to zero. So you have to know which ones to buy, and you have to have enough diversification for the portfolio. But that's where you can build a portfolio that has some physical gold and some gold stocks, and then has more traditional investments inside it that still provide protection because they're outside the United States and they provide another asset class and a source of income. But maybe your gold stocks and your bullion will end up being your best performing investment, which is fine because you own it and the performance could be overwhelming. But in case it takes longer than we think, you stay in the game because the rest of your portfolio is still performing, because it's not simply a bet on bullion or a bet against the dollar, because you have these income generating assets that can do well in any environment.
A couple of the things I'm doing, I actually think that this crisis could get really bad. I think that if the currency crisis is bad enough, you could see rioting and things like that. So I have an emergency food supply. I know that you don't think much of Bitcoin, but I really studied Bitcoin, and I think that actually it would make a great currency system. It's a free market answer to national currencies. And whenever there is a crisis and people rush toward other things, it's one of the other things that is not stocks or bonds And so I've got a very small allocation in Bitcoin. But most of my assets are gold, silver. There's cash, Bitcoin. I currently don't own any stocks. I got out of all of them right now because I think the stock market is severely overvalued. I have an advisor that put together a trade with where you sell a couple of puts and buy a put, and the risk profile is that if stocks go up, you make a small percentage. If stocks move sideways for a year, you could lose. If stocks go down, you make a killing. And I like that trade. I'm going to put one of those on. I believe that the stock market is topping, and I think that even if they do start QE again, that there will be a lag time. That the markets, I don't think the Fed's going to be able to control the markets. I think that the markets are bigger than the Fed. I think that the Fed is reactionary. They're not anticipatory. They're not. So I'm sort of going against things, and I don't have all the diversification that you're talking about because I'm pretty darn certain that this is a currency crisis and a bond crisis, and the one thing that you want to be in more than anything else is gold and silver, and so that's where I am.
Well, yeah. Well, I'm in there with you. Maybe just not to the same degree. Because, I've known that this crisis was coming for a while, and sometimes you can be surprised by how long it takes. These bubbles can get bigger and bigger and bigger because so many people don't understand them. And, you've got all the academics and mainstream, the same guys that had no idea that we were around the corner from a financial crisis in 2007, right? They've sounded the all clear. They think the problems that they didn't understand have been solved. In fact, problems that they created, right? We know they didn't solve them. They're looming larger than ever, but how many more years or maybe months is it going to take before there's a collapse? And yeah, the stock market should collapse because it's way overvalued and interest rates have to go up. But the stakes are now so high that the government may not let it collapse. And yes, if they print enough money, the nominal price of stocks won't collapse, but their real value will. They can put a floor beneath the stock market if they want to. The Fed can just buy stocks. They have the plunge protection team. They can print money and buy stocks, and they probably will. I don't think at this point they're going to let these markets implode because they're all in on this. I mean, they built this recovery on the foundation of the wealth effect, right? Trickle-down monetary policy, right? If we just goose the stock market and the real estate market, everybody's going to spend. I mean, their reputation is on this. And so I think they're going to do what they can to keep these markets propped up. And they do that by sacrificing the dollar. And so owning gold makes a lot of sense. I mean, Bitcoin,
That's more of a speculative play.
Well,
so is this shorting thing. This is something that is a speculative. I see gold as the sure thing.
All these big disasters are man-made. I mean, you think back to the Depression. I mean, that wasn't an accident, and that wasn't some inevitable flaw of capitalism. The government did that. I mean, the government created that, right? The Federal Reserve inflated the stock market bubble, and when it burst, it was the government that created the Depression. It wasn't a consequence of that because, the Depression of 1920, right, which nobody knows about because it was over so quickly, that one began even worse than the Depression that started in 1929. But the difference is, back in 1920, Herbert Hoover was just in an administration, and his calls for government intervention were unheeded. But by the time Hoover was president, he's the one that pioneered an unprecedented amount of government intervention. He tried to stimulate. He tried to help offset the downturn, and he created the beginning of the Depression. And then Roosevelt, right, came to power criticizing Hoover for his big government policies, criticizing his deficits, promising to balance the budget and shrink government, which is exactly what worked in 1920. But unfortunately, when Roosevelt was elected, rather than abandoning Hoover's policies, he expanded them.
Right.
And so the Great Depression didn't end until the Second World War ended. And we finally shrank government because we ended the war. But that was a man-made crisis. And the one that's coming up is going to be even worse because it's made by men of the same character, the same way of thinking. Only we're starting it from a much more vulnerable position. The U.S. economy was far more solid in 1929. than it is today.
It was an economy built on infrastructure instead of speculation.
Well, it was built on production and savings. And remember, in 1929, no one had ever heard of Social Security because it didn't exist. There was no welfare. I mean, they called it relief when they first started it, but it didn't exist. The government was like 4 or 5% of the GDP. Right? Now we have an army of Americans. Almost 100 million people don't work in the United States. I think about 45% of Americans work 30 hours or more a week or more. We have so many people depending on a government that's broke, right? That live in an economy that's depending on the charity of the rest of the world. We need imports. And if we can't print dollars to pay for them, how are we going to get these products that we all take for granted right now? So this is we're on the precipice of something huge. And you've got the powers that be telling us everything is great and there's nothing to worry about. Right? But there's a lot to worry about, and people have to do what they can on their own to protect themselves.
The two things that I can see that people can do to protect themselves is to become financially educated and to take their destiny in their own hands and not buy the hook, line, and sinker, the spiel from the financial the regular financial sector. They're right for a little while, but then when things go wrong, it's catastrophically wrong, and it wipes people out. And one thing that doesn't fail is the precious metals. They always have a value. And so...
Yeah, most people are taking their financial advice from these big Wall Street banks. All of them would have failed had the government not bailed them out. That's how little they actually understood about the markets that they were advising people on. And these same people who were completely blindsided by the events of 2008 had no idea that this disaster was around the corner, who got bailed out by the government. People are still taking advice from them. They have no idea what they're talking about. Maybe they're confident that there's going to be another bailout. But the next crisis is going to be centered on the government. And when the government is broke, when the Federal Reserve is broke, who's going to bail them out? There's nobody, right? We've reached the end of the game. There are no more bailouts. You have to bail yourself out. And you do that now by being prepared and educating yourself and buying the assets that will preserve purchasing power in this crisis.
Thank you very much. That's exactly what I feel. It's just financial education and buying the assets that you feel are going to protect you.
And it's not just about educating, because first you educate yourself and then you have to act on what you learn. You can't procrastinate. You can't get complacent and leave it for another day, because one day there won't be another day.
It's better to be years too early than 1 second too late.
Absolutely.
Thanks. That's perfect.
Okay.
Thanks for watching. I did a study taking the performance of the Barron's Gold Mining Index versus physical gold from 1971 until today. And the physical gold had outperformed Barron's by 400%.
Yeah. Oh, yeah, there's no question that I think gold stocks right now are significantly undervalued. And I think gold stocks basically reflect Wall Street's opinion on the future price of gold. And they discount that into the present. And, people are universally bearish on gold right now. And so that impacts the mining companies a lot more than the physical gold. But, what's going to be the big eye-opener or game changer in the gold market is when more and more people wake up. I mean, you've got people in emerging markets, people in China, India, who understand, and they buy gold. I mean, the average man on the street is buying gold. But in the big Western wealthy economies where people are complacent and don't understand these risks, people have no gold. And we have all this paper wealth, which in reality isn't wealth at all. It's just a claim to wealth. When people own gold, they actually have wealth. Gold represents something real, and you can always exchange that for some other form of wealth. But these little pieces of paper, whether it's dollars or euros or yen, they're just claims to wealth. And people have confidence that they can always cash that in for real things, because nobody just wants paper money. They want the things you can buy. That's the difference. People do want gold. Yes, they want what you can buy with gold, but there is a use for the actual gold. Gold is desirable for itself. Dollars are only desirable for what you can buy. And you can only buy something if people are willing to take it. But I think when people realize this scam and they see what's going on, there's going to be a rush to get out of these fiat currencies, particularly the dollar.
Yeah.
And you know what? There's just not enough gold there, not at these prices. In order to accommodate this new wave of demand, prices have to go up dramatically. I mean, sure, it doesn't matter how much gold there is. People say, well, there's not enough gold to go on a gold standard. Sure there is. The only variable is the price.
Right.
There's enough gold at a price. Is there enough gold at $1,200 an ounce? Not a chance. But there might be enough gold at $10,000 an ounce or $20,000 an ounce. The market's going to have to find the equilibrium for where gold has to be repriced for the monetary system to work again.
Yeah, I've done a lot of studies on that. When I was writing my book, if you were going to make base currency, the paper dollars that exist, redeemable in gold, it took $6,000 an ounce back then. Before Ben Bernanke added another four, before he quintupled base currency. So now we've added 400. We basically, it took 200 years to create the first 0.8 trillion of base currency, and now we're at 4 trillion. So we've created 800 years worth of currency basically in the past 6.
And they're just getting started as far as I'm concerned.
Right, yeah. And so, so long-term outlook for gold. One of the topics that was suggested to talk about was gold and silver in the next 5 years. And I prefer people all the time ask me where I think gold is going, and they mean next month or next year. And I'm not interested in that. What I'm interested in is, by the year 2020, where do I think gold is going to be? Because I can't predict tomorrow, but I can predict the outcome of the Keynesian idiocy that's going on right now. And it's going to be, we're in, I've been saying for a long time in my series, Hidden Secrets of Money, that that this is one of the greatest financial crises that you can turn it into your opportunity if you want. When I say that we're in this great financial crisis, during periods where the stock market goes up like that, people think I'm a nut because they don't see a financial crisis. This crisis is one that's playing out since the NASDAQ crashed in 2000, and it's getting worse, and it's going to culminate in, the 2000 we had a stock market crash. 2008 we had the stocks and real estate. This time it's going to be stocks, real estate, and currencies and bonds.
Well, that's why it's so big.
Bubble. Yeah. Well, bonds is currencies, though.
Right. Well, it's even worse. It's a promise to pay currency in the future when it'll have even less value. But that's why we have a simultaneous bubble in stocks, bonds, and real estate that dwarfs the previous bubbles. But this is all the consequences of the kicking the can down the road, right? But, we're getting to the point where we're running out of that road, right? Where we literally are going to overdose on the stimulus, and the consequence is going to be in the dollar. And it's a dollar crisis. That's why when you ask, how high is gold going to go, it's really how low is the dollar going to go. And I'm not talking about just its exchange rate versus some other fiat currency. It's just in an absolute sense, what can you buy with a dollar? And more particularly, how many ounces of gold can you buy with a dollar? Because way back when, before Roosevelt devalued, right, you only need $20. You only needed $20 to buy an ounce of gold. And then after they seized the gold and they revalued, you needed $35 to buy an ounce of gold. Now you need about $1,200 to buy an ounce of gold. So the dollar has lost tremendous purchasing power relative to gold. But I think we're just getting started.
Yes.
Because I think you're going to see an enormous loss of purchasing power in the next 5 to 10 years. Who knows, how many dollars you're going to need to buy 1 ounce of gold. But, of course, it's not just gold that's going to be getting more expensive. It's going to be everything that's getting more expensive. But I think if you want to preserve your purchasing power, you do it with gold. Because I think while everything is going to be getting more expensive in terms of gold, which would be, in terms of whereas everything is going to be getting more expensive in terms of dollars, right? It's going to be getting less expensive in terms of gold.
Yeah.
So, yes.
That's what I look at when I look at time periods like this. There's this big wealth transfer, and the most undervalued thing right now, I think, is gold and silver. And when people panic, and people think that some people call it gold an inflation hedge, but it's really a currency hedge and a crisis hedge.
Well, it's a preserver of value. And,
well, even more than that, though, it has the potential of these great gains in purchasing power during these revaluations.
Well, that's the deflation. When people talk about deflation, right, if you have cash, if you have money, deflation is good, right, because it means that everything you want to buy gets cheaper, whether it's assets like real estate or stocks or consumer goods. And I think we're going to experience massive deflation if you own gold. See, if you own dollars, you're going to experience the opposite. You're going to see inflation. You're going to see the prices of everything you want to buy go up, right? So, but that's not where you want to be. You want to be in a position to be able to take advantage of the bargains, right? If all you have is dollars, you won't see any bargains. You're going to see price increases. But if you've got a lot of gold, there's going to be bargains everywhere. You're not going to need as many ounces of gold to buy a house or to buy a car or to do whatever you want to do.
We were just talking about a piece of property in Puerto Rico, and I said I'm waiting for it to go down in terms of gold.
Right. It may never come down in terms of dollars.
Right. It
but it may
seems
crash.
like an extreme bargain right now, this piece of property, but I really think I'm going to be able to get it for less than 25 cents on the dollar in terms of gold.
Yeah. Well, here's the thing. Everybody around the world owns property. They own stocks. They own, fine works of art. They own, classic cars, right? But not that many people own gold right now. And when all the people that are collecting everything but gold realize that they need some gold, they can't get it at today's price. They have to bid it up. So what you want to do is be in a position to own that gold now and sell it to them when they need it. And now you can take little bits of gold and you can buy some of their art. You can buy their classic car. You can buy some of their real estate. Because you want to have what everybody wants, and you want to buy it when no one does.
Yeah, right. And right now gold is so out of favor. People don't realize how undervalued that it became, like in the year 2000. People thought that, back then, I started buying gold in 2002, after I was fairly sure that there was a bottom in. And then I actually started pitching it to people and trying to get people to buy it back in 2003 and so on. And when gold was in the 300s, under $400 an ounce, people were saying, "Are you crazy? Gold's been going down for 20 years." And I'm going, exactly. It's been going down for 20 years. And so,
that's about when I started buying it for the clients of my brokerage firm. I have Euro Pacific Capital where we're buying stocks and bonds, but I started to encourage people to buy gold. I first started with the mining stocks in 1999, 2000, and then I added physical gold in 2001, 2002-ish. And we started buying. Silver was still below $5. Gold was below 300, and nobody wanted to buy it. And I went on television, and I was on with a guy from CNBC, Mark Haynes, who unfortunately passed away, but I started talking about gold, and I said, gold's up $50 just since the last time I was in your studio. And he said, gold, who cares about the price of gold? Why should I care about the price of gold? And I said, well, you should care, and eventually you will when the price is higher. And the price kept going up and up and up. It eventually hit $1,900 an ounce. But the interesting thing is now it's corrected itself for the last 2 or 3 years, and everybody is saying, oh, see, we told you. PeterSchiff was wrong. Don't buy gold. We said it was a bubble. I mean, they've been saying that since under 300. Now they finally get a correction. They think they're smart. They were a stop clock. But, we did get, unfortunately, we had some of the mainstream investors jumped into gold after a 10-year run when, guys like John Paulson, who had been short subprime and publicly made a lot of money, started buying gold. All of a sudden, it became more mainstream. People were worried about the economy in 2010, 2011. They were worried about QE. They were worried that it would end the disaster, which it would. But now everybody is convinced that it's a success. All the people that came into gold late in the game so far bailed out, sold all their gold, took their losses, and they think the rest of us are a bunch of fools. But gold is just waiting, biding its time.
I think it's going to prove out to be one of the greatest bull markets in history by the time this gold bull market is done.
Oh, yeah, and I think that
this is just the mid-wave correction in this.
Well, given what the Fed has done and given what they're likely to do, I think gold's a better buy today at $1,200 than it was 15 years ago at $300.
I pretty much agree. I've got charts on that. I look at the spread between the value of the gold held at the Treasury, the number of ounces divided by the price, which has been loaned to the Federal Reserve, but that's another story, divided by the base money supply. And the spread between the two now is every bit as, it's probably larger than it was back in the year 2000. But in the year 2000, gold was the most unloved and ignored asset that there was. It had gone into a little bubble in 1980 from $35 an ounce to $8.50, and then a brutal 20-year bear market. And at the same time, all countries on the planet had abandoned it as money. So for the very first time since the 70s, no country was using it as money. By the year 2000, investors had given up on it too. And at the same time, paper assets like stocks and so on were the most overvalued.
Oh, yeah. I mean, you had
NASDAQ bubble. And
you had the new economy. And remember back then in 2000, people were actually so foolish. Remember, they were talking about surpluses as far as the eye can see.
Yeah.
They were wondering what was going to happen when we paid off the national debt.
Right.
Like people were worried about not having enough treasuries. That's how crazy it was.
Yeah.
But what's even more interesting is as negative as people were on gold back then, after this 20-year bear market and a huge bubble in the NASDAQ, as negative as professionals were about gold then, it's actually more negative now. Gold is even less loved today, despite the fact that it's outperformed. If you go back to 2000, the price of gold has significantly outperformed the stock market.
Mm-hmm.
Yet
and
despite
real estate.
that, yes, but despite that, people hate it more now than they did back then.
Right.
So from a
So the
sentiment
opportunity right now is great.
Yeah,
Yeah.
It is tremendous, and I think people are going to be alarmed by the speed with which this metal rallies once it starts to go. Because I do believe that a lot of that gold that was sold by the speculators who bought in, around 1600, 1700, 1800, right? A lot of that gold was bought up by China, by foreign central banks. That gold is never going to see the light of day again. So when the speculators want to get back into the market, there's no gold for them to buy. And you also have a lot of shorts. You have a lot of people who have sold gold that they don't even have. And they're going to have to scramble to buy it back. And who's going to sell it to them? Not me.
Right.
Not at these prices.
It's a shame seeing all the gold going from west to east, too. I mean, it just shows that after the currency crisis, we're going to be a lot poorer in this country.
Well, we are a lot poorer. We just don't know it. They've been supplying us with merchandise and credit, but they've been smart enough to take the gold, and the gold flows to where the prosperity is, where the surpluses are, where the production is. America, we accumulated almost all the world's gold. By the Second World War. I mean, that's the whole Bretton Woods system. The dollar was the reserve currency, not by accident, but because we had all the gold. And the dollar was as good as gold because we had the gold and we backed the dollar by gold, and our currency was convertible into gold on demand by the bearer. But we accumulated that gold because we were the freest people on the planet, and because we were free, we were productive. We manufactured all the things that the world wanted to buy, and they needed dollars to buy those things. But we are the mirror image of that nation today. We're the world's biggest debtor, not the world's biggest creditor. We have huge deficits. China has more in common with what America used to be than America does today.
Agreed.